We all know that investing in equity is the key to long-term wealth creation and wealth. However, it is important to remember that not all stocks are created equal. While mid and small caps have the potential to generate higher returns, large caps offer stability to your portfolio. But that doesn't mean you should ignore any of these stocks. So you must benefit from the high growth offered by mid and small caps and enjoy the stability offered by large caps. The most successful investors are not built in a day. Learning the ins and outs of the financial world and your personality as an investor takes time and patience, not to mention trial and error. Stay with us to know more about investment. Getting started in investing. Successful investing is a journey, not a one-time event. And you should prepare yourself as if you were going on a long journey. Start by determining your destination. Then plan your investment journey accordingly. For example, are you looking to retire in 20 years at age 55? How much money will you need to do it? You need to ask these questions first. The plan you come up with will depend on your investment goals. The goal of investing is to generate income and increase value over time. An investment can refer to any process used to generate future income. This includes the purchase of bonds, stocks, or real estate properties, among other examples. Additionally, the purchase of an asset that can be used to produce goods can be considered an investment. In general, any action taken with the hope of increasing future revenue can also be considered an investment. For example, when pursuing additional education, the goal is often to increase knowledge and improve skills. The upfront investment in attending classes and paying for tuition is expected to increase earnings throughout the student's career. Since investments are oriented toward future growth or income potential, there is always a certain level of risk associated with investing. An investment may not generate any income or may lose value over time. For example, the company you invest in may go bankrupt. Alternatively, the degree you invest time and money in may not result in a strong job market in that field. An investment bank offers a variety of services to individuals and businesses, including many that are designed to assist individuals and businesses in the process of growing their wealth. Investment banking can also refer to a specific category of banking concerned with raising capital for other companies, governments, and other entities. Know what works in the market. Read books or take an investment course that deals with modern financial ideas. The people who came up with theories such as portfolio optimization, diversification, and market efficiency received their Nobel Prizes for good reason. Investing is a combination of science and art, qualitative factors. The scientific aspect of finance is a solid place to start and should not be ignored. If science is not your strong suit, don't fret. There are many texts, such as Stocks for the Long Run by Jeremy Siegel, that explain high-level finance ideas in a way that is easy to understand. By knowing what works in the market, you can come up with simple rules that work for you. For example, Warren Buffett is one of the most successful investors of all time. His simple investment style is summed up in this well-known quote: "Never invest in a business you don't understand." It served him well. While he missed the tech boom, he avoided the devastating recession that followed the high-tech bubble of 2000. Know your investment strategy. No one knows you and your situation better than you. Therefore, you may be the most qualified person to make your investment. All you need is a little help. Identify the personality traits that will help you or hinder you from investing successfully and manage them accordingly. A very useful behavioral model that helps investors understand themselves was developed by fund managers Tom Ballard, Larry Beal, and Ron Kaiser. The model classifies investors according to two personality traits: action style, or cautious or anxious, and confident level, or confident or anxious. Based on these personality traits, the BB&K model divides investors into 5 groups. First, individualist, cautious and confident, often taking a do-it-yourself approach. Second, adventurous, restless, entrepreneurial, and strong-willed. Third, celebrities, followers of the latest investment fads. Fourth, guardian, highly risk-averse, asset conservator. And fifth, straight arrow, shares all the above properties equally. Not surprisingly, the best investment results tend to be realized by an individualist or someone who exhibits analytical behavior and confidence and has a good eye for value. However, if you determine that your personality traits resemble those of an adventurer, you can still achieve investment success if you adjust your strategy accordingly. In other words, regardless of which group you fit into, you should manage your core assets in a systematic and disciplined way. Know your friends and enemies. Beware of false friends who only pretend to be on your side, such as some unscrupulous investment professionals whose interests may conflict with yours. You also need to remember that, as an investor, you are competing with large financial institutions that have more resources with greater and faster access to information. Bear in mind that you are potentially your own worst enemy. Depending on your personality, strategy, and particular circumstances, you may be sabotaging your own success. A guardian would be going against their personality type if they were to follow the latest market craze and seek short-term profits. Because you are risk-averse and a wealth preserver, you would be affected far more by large losses that can result from high-risk, high-return investments. Be honest with yourself and identify and modify the factors preventing you from investing successfully or moving you away from your comfort zone. Find the right investing path. Your knowledge level, personality, and resources should determine the path you choose. Generally, investors adopt one of the following strategies. Don't put all your eggs in one basket. In other words, diversify. Put all your eggs in one basket, but watch your basket carefully. Combine both these strategies by making strategic bets in a core passive portfolio. Most successful investors start with low-risk, diversified portfolios and learn slowly. As investors gain more knowledge over time, they become more apt to take more active positions in their portfolios. Be in it for the long term. Sticking with the best long-term strategy may not be the most exciting investment choice. However, if you stay the course without giving in to your passions or false friends, your chances of success will increase. Be willing to learn. The market is hard to predict, but one thing is certain: it will be volatile. Learning to be a successful investor is a gradual process, and the investment journey is typically a long one. At times, the market will prove you wrong. Acknowledge that and learn from your mistakes. Whether you are just getting started or want to improve your skills, check out the Investopedia Academy, where we have dozens of online courses for every kind of investor. Open a trading account in under 5 minutes. Open a trading account in 5 minutes and join 900,000 others worldwide to trade long or short on oil CFDs and access 1,000 plus other CFD products such as Forex, gold, indices, and shares with an award-winning broker. Trade oil spreads from 0.4 on Vantage's raw account and access free education and trading tools with 24/5 phone support. In its simplest form, the investment return and risk should have a positive relationship. If an investment carries high risk, it should be accompanied by high returns. If an investment is safe, it will often have low returns. When making investment decisions, investors must gauge their risk appetite. Every investor will be different, as some are willing to risk policy losses in exchange for higher profit opportunities. Alternatively, highly risk-averse investors seek only the safest vehicle, where investments will only grow consistently but slowly. Investments and risk are often strongly related to the conditions existing in the investor's life. As an investor approaches retirement, they no longer have stable ongoing income. For this reason, people usually choose safer investments toward the end of their careers. On the other hand, young professionals can often bear the brunt of losing money because they have their entire career to pay back that capital. I hope this video was quite helpful for you. Thanks for watching, and we'll catch up in the next video.